Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we zero in on the hotly debated topic of modern monetary theory and how its use may be a solution to economies embattled with the coronavirus. Modern monetary theory, or MMT, is an unorthodox macroeconomic theory that describes currency as a public monopoly. Issues like unemployment are caused by scarce currency supply, restricting the availability of the financial assets needed to pay taxes and satisfy savings desires. Generating more of it at a fiscal or government level will then create employment and stimulate demand. The opposing view is that it is a far-fetched Bolshevik pipe dream that will destroy wealth and society as we know it through hyperinflation. To help colour in whether MMT may be a solution to the coronavirus economy, we are lucky to be joined live from Thailand by renowned Australian economist and author Professor Steve Keen. Through his work in popular books such as Debunking Economics and Can We Avoid Another Financial Crisis, and his weekly podcast through his Patreon page, Professor Steve strives to educate the world on the failings of neoclassical economics and highlight the risks of the insatiable drive for more debt in modern society. Professor Steve Keen, welcome back to Nucleus Investment Insights.
Good to be here, guys. I'm glad we've got the technology worked out at last.
We have indeed. And joining us as well today, of course, to discuss today's topic and explore how they may be used in our portfolios, I'm joined by Nucleus Wealth's Head of Investments, Damien Klassen.
Hi, Tim.
G'day, Damien. And just a quick reminder that before we get started, to subscribe on YouTube and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. And for those listening in live, feel free to drop in your questions in the chat box at nucleuswealth.com/webinar, and we'll have those answered along the way. So we'll kick off today with our agenda. So we're going to start by just having a look at the overall crisis at a top level. We'll then be diving into some fiscal responses, followed up by some monetary responses, and then bring in the question of the day, which is of course, the modern monetary theory responses as well. So on that note, I'll jump over to Damien Klassen, if you like, and we can get the ball rolling.
Thanks, Tim. Yeah, look, Steve, I guess I wanted to start this from I guess to get your view on our take, which has been that we're sort of arguing the economy was already pretty vulnerable pre-crisis, and that with Australia, particularly high household debts, some of the other countries, say the US, particularly high corporate debts, we'd sort of hit this cyclical peak, and that the coronavirus is going to magnify that effect. And so that we're sort of feeling that the effect we really need to watch for now is not so much the slowdown, which is obviously very important, but it's whether that then sends companies broke and sort of sends through that whole bankruptcy process where you get the deleveraging, which then really causes the next leg of the downturn. And given many countries have sort of suspended bankruptcies and stopped people from stop companies and people from being kicked out of homes for short periods of time. Our view is that means that we've just sort of delayed the start to the process. And so I'd be interested in seeing your thoughts on that, and as to how much of an issue that.
Yeah, look, like that's exactly the perspective I had right from the beginning of the crisis, because, as you know, my focus is on the role of private credit and debt and private debt in driving the economic performance, and how if you accumulate too much private debt, you get a boom while the debt's going up, and then a crash when people start to delever, either because they deliberately try to pay their debts down, or they go bankrupt, or the banks go from lending to foreclosing. And every one of those downturns has given us a depression. And now what we have, we managed to avoid one in 2008 by a massive level of government spending, particularly in Australia, but also in America. But what that did, as well as a side effect, was it stopped the private sector deleveraging. And if you look at where we are now, it's 12 years, after the global financial crisis, 2008, 2020. And the level of private debt, take the American economy, which is the best one to compare, the level of debt has fallen from 170% of GDP to 150%. Which is pretty small, 20% fall. If you go back to the Great Depression, the level of debt then was driven up by massive deflation. That's one of my worries for now as well. It peaked at 143% in 1932, By 1945, that's a bit longer, 13 years, so rather than 12, it had fallen to 37%. So more than 100% of GDP fall in the debt ratio back after the Great Depression. We then had the golden age of capitalism. This time, just a 20% fall, and bang, we're hit by the coronavirus. There's so much leverage out there and so much in the way of financial commitments that people can't meet because the income has been trashed by the coronavirus effect, both its direct effect and by the lockdowns. That if we don't do something, the financial system will crash the economy once the coronavirus is finished with our health.
Yeah, and so the sort of the stopping bankruptcies and stopping people from being kicked out of homes, to me, sort of made sense in a very short period of time. You don't want companies to go broke for the sake of a month shutdown or a 2 month shutdown. Now that we're sort of moving into, obviously, we're here for a while, and things aren't going to rapidly improve. I guess you get to the stage where some of the good actors start getting dragged down by some of the bad actors, because the bad actors just keep racking up debts. I guess, do you keep that in? How do you look upon that in terms of how you're looking at the private money creation and the effects on banks' sort of willingness to lend?
Well, banks aren't willing to lend at all right now. If you see the lending that's taking place, it's really distress borrowing by companies that have lines of credit or overdraft facilities. There's been an enormous increase in corporate debt in America when the coronavirus hit, but it's really saying we've got to, we haven't got the monetary, the sales cash flow. We've got to access our lines of credit to remain afloat. So bang, the debt levels are rising, but it's not because people are voluntarily borrowing. It's if they don't borrow, they can't pay their wages, what's left of them. They can't pay their rents and so on, which they can't get out of. And bankruptcy will ensue immediately rather than later. So my feeling is this is one of these. It's an incredible instance of what economists fantasize causes all crises, which they blame it on exogenous shocks. Well, most of them are endogenous financial cycles. In fact, this is an exogenous shock, and rather than capitalism responding rapidly and going back to equilibrium, the cash flows of capitalism collapse. And the only way you can get over the shock is by using an institution which has no limit on its capacity to create money. And that fundamentally is a currency issuing government.
Yes. And so, so I guess according to your, looking at your theory though, basically you need that currency issuing government to then convince banks to keep lending. Is that?
No. You replace. You literally do. I mean, even a corporate version of a UBI. You simply have to. The capitalist system is a financial and monetary system as well, and mainstream economics has completely ignored that and treats it as if it's a barter system. So therefore, there can be no financial crisis in their models, which are not the real world. We live in the real world. There is a financial crisis. If people continue racking up the commitments they had, which were based on the income flows before the coronavirus hit, then they're not going to be able to do it and they'll go bankrupt. And even though they've still got all the physical resources and the physical demand is still there, the economy will tank. So while you're effectively in the economic version of the intensive care unit, you can't rely upon your own lungs. And therefore, can somebody else provide oxygen? Yes. And this is what modern monetary theory is about, really explaining that the accounting involved in how government creates money is such that they have none of the limits that apply to a private actor. And therefore, they can, and there again, I think the ICU analogy is pretty useful. They can supply the oxygen that you can't get into your lungs anymore. And that keeps you alive. And then when you get out of ICU, you can say, let's take away the supports from the state and go back to a standard capitalist system.
Yeah, I guess where I was getting to was, obviously within if you've got a bank that's, you got your case of the businesses who sales have dropped, they need to go into debt in order to pay their bills. Obviously, that's not productive debt. Whereas if I'm actually borrowing to build a new factory and I'm actually expand the business and you can see the sales rising to then pay off the debt, you can say, okay, well that debt makes sense, and that's that's a positive for society. Whereas the debt just to replace lost revenues, and it's gone. There's no productiveness. You're just digging a hole deeper. And I guess as you go through crises, quite often what you see is good bank, bad bank type thing happen, where governments shovel, or governments then shovel all the bad loans into one bank. So then you can say, okay, now the good banks can get back out and just doing a normal job about running, borrowing, lending to people who have solid incomes or business plans that make sense and things like that. And you can, whereas if they're stuck together, the banks are so busy trying to limit their losses to all these bad companies that they just don't want to. They've got no appetite to chase new loans. So I guess what I'm saying is, if you're looking at saying, so banks, we don't, I guess limiting the private banks or not involving private banks in the solution. There's sort of like this hole we've got to fill in where the banks were lending a lot of money to keep the current economies going. Like our current economies are based on the accumulation of this more debt just to keep things ticking along. And so central banks have to sort of fill that gap first before they can then start putting more money into, MMT has to fill that gap of lost private lending, and then they have to fill the gap of lost jobs before we can actually start getting back into a net positive.
Yeah, that's right. I mean, again, think intensive care. This is not a healthy economy. If you took away the government, then we would be roaming the streets looking for blades of grass right now. Okay, with the scale of the downturn. Think of people not getting unemployment benefits, let alone JobKeeper and all those lovely one-word phrases that Scotty from marketing has developed. Without all that stuff, there would be complete chaos at the moment compared to what there is, which is partial chaos. So let's just, given when this struck, if this struck back in the 1950s, we wouldn't even be having this conversation, because back in the 1950s, the level of American debt was about 50% of GDP versus 3 times as much now. So the timing of the crisis, coming on top of an unresolved financial crisis, let's just get the financial crisis out of our hair while we deal with the coronavirus.
So, Steve, just quickly, and sort of borrowing on that ICU analogy, that obviously, you go into the ICU, you're all, treated on basically a triage of who needs the most amount of care or oxygen, and then sort of, but at the end of the day, everyone sort of, the idea is everyone gets their needs met. Would you use the same thinking in the corporate space? I guess this goes back to this whole zombification problem that people are worried about now, where companies are allowed to operate, using enormous amounts of debt and really just getting by, and something, a problem like coronavirus comes up, which should actually clear the sheets out a little bit, clear out, the problem companies that have been allowed to sort of exist with huge levels of debt. Is the government sort of just perpetuating that zombie issue in the interim, using the free oxygen?
Well, it's been doing that with QE for the last 10 years. So, there's nothing new about it under the coronavirus. The QE has been, a support for the parasites on Wall Street rather than the factories on Main Street. And then given the fact that you have an economy which is not in what Larry Summers calls secular stagnation, it's in credit stagnation. With that stagnant credit demand, corporations look at what they're getting in terms of a cash flow from selling bonds to the government, and the only thing they can think of doing with the money is retiring their own shares, which is where the industrial stagnation is coming from as well, the development stagnation. So this has been going on forever. The last time to worry about getting it precisely right is a crisis like this. Okay, if we're still in the aftermath of the financial crisis itself, then yes, I'd have someone going through the books very carefully and deciding who gets rescued and who gets put into receivership. But this thing, you just want to keep the cash flow going. And my preferred solution was simply for the government to provide households with the money necessary to meet their normal financial commitments and basic expenditures. And until such time as we have contained or defeated the virus, or in the worst possible situation, we come to live with its consequences indefinitely. But until that point, just give everybody a cash flow that covers their expenditure needs, and therefore means that they can pay the companies that then pay the banks, and so nobody goes bankrupt because of the virus.
Sure. Okay.
And is that though? Well, I guess there's. Do you think that's likely? Or it's
we'll do the right thing.
Yeah, that's right.
No, I don't.
Yeah, exactly.
I mean, what I find remarkable about economic policy is that when you're in a period where the economy appears to be operating normally, and by normal, neoclassical economists and mainstream policymakers think, they see a horizontal line, effectively, nice, stable rate of economic growth and low rate of inflation, and those two flat lines make them think everything is hunky-dory. When you take a look at the data the way that I do and focus on the role of credit, that so-called flat line is driven by an exploding line, which is the level of private debt to GDP, as people borrow into Ponzi schemes. Fundamentally drive up the level of economic activity while they're borrowing, and then the Ponzi schemes collapse and the whole system comes crashing down. So I'm looking at that third factor, the rate of growth of private debt and credit, and therefore I'm waving my hand saying you can't keep on going like this. This isn't normal. There will be a turning point. When it happens, those two flat lines you see going horizontal and their nice growth rate and nice rate of inflation will turn into collapsing GDP and deflation. Well, when it actually hits, which is what happened back in 2008, you get the people in charge throw their textbooks out the window and go into panic mode. And in panic mode, they do what they should have done beforehand. So only when they're in panic mode do they make the right policies. So when the coronavirus first hit, even Donald Trump agreed to give workers money in America, that $600 a week, I think it was, to tide them over, too short a period of time, but they still did it. And you look around the globe, everybody is doing some version of a universal basic income right now, whatever they might call it. Most central banks are enabling firms to continue operating, or banks to continue operating, even if they've got dodgy books right now. So they're giving but when they think it's all over, they go back to the textbook, and they're in the post-bubble world. When you have declining credit or declining levels of private debt, those two flat lines never come back to the way you thought they would.
But how long do you think before? How long before this becomes an issue? In that, if you don't let a company go broke, and the company decides, I'm not going to pay my leases on my shops, I'm not going to pay my suppliers, I'm not going to pay these people, and I'll just keep switching. My one supplier stops supplying stuff to me because I've racked up bills with them. I'll switch to another supplier, and I'll just keep going, and I'm just hoping that something will happen. Some manna from God, the gods that'll save me. How long before you start, if you don't let companies go broke, that becomes endemic, and all the good companies start falling over because the bad ones aren't meeting their
I don't think there are that many Alan Bonds out there, are there? I mean, they certainly exist. But if you provide a cash flow that means that people don't face that life or death decision, then I'm still sufficiently naive to think the majority of companies are going to continue paying their commitments, because that's one of the side effects of getting one of the expectations of getting the cash flow from the government. You need to have decent regulators with teeth, but the last country in the world that can talk about that is Australia, with ASUC. Is it called ASUC? That's how you pronounce it, isn't it? ASUC? Okay. They suck up to the financial sector. And when they try not to, when they try not to, they get a judge who says that people should stop buying Wagyu beef and drinking expensive Shiraz. I mean, talk about a country which makes it impossible for regulators to have teeth in the first place. So you're just basically got two choices. You can have, either you have a badly done rescue where some assholes, Alan Bonds, pardon me to use their proper term, can get away with blue murder, but the rest of us continue functioning, or you let us all go down because there might be a few Alan Bonds.
Fair point. Yeah.
Okay, so I guess from your perspective then, so if we get, let's say JobKeeper and JobSeeker get extended by another 6 months or another 12 months, and companies aren't allowed to go broke, well, we keep the provisions so you can trade insolvent for another 12 months. That's not you think that's probably a muddling through path that you'd be comfortable with? I guess.
Yeah, I'm comfortable with better than that, than letting all corporations collapse and people have to go on the streets to try to find what's left, what resembles food. When it's not, we're not in a. Thank God this virus is only about 5 times as deadly as the ordinary flu. And if it was as deadly as Ebola, then it would be a very, very different conversation indeed. But we have something which we simply haven't faced an event like this for a century. We have far more mobility than we had a century ago, and we have far more fragile production systems because of the ridiculous length, the geographic length of modern supply chains. In the midst of all this, we have to unravel a lot of mistakes we made beforehand, such as letting supply chains get that long. And you don't want to exacerbate it by having financial breakdowns in the meantime. And that's one reason why MMT is so important, because it explains there are all the deadly consequences that mainstream commentators, people like Klassen, for example, see about the monetary system as simply wrong once you look at the accounting.
And at what stage? I mean, so obviously, most people talk about the inflation issues in terms of MMT, and I'll put those to the side for a minute, because I do think there's a certain element of worrying about my teenage daughter just started holding hands with her boyfriend. She's about to be she's about to get pregnant and leave school type stuff. There seems to be a big cognitive jump between we might do a little bit of printing to keep the money alive versus it's
Zimbabwe,
Zimbabwe, exactly. But there is an element of saying, and particularly if what we're talking about is saying we're going to have a lot of people without jobs, and we're going to keep providing all these people money to have their normal life, although there's lots of these people without jobs, is that then you just start getting into this part about going, well, we've got too much money chasing too little. Like, we haven't got enough people working out there, and if we haven't got the incentive to get people back out and working, you end up with too much money chasing too little supply, or you get that money shipping to China because they're happy to push the supply side, and so Western countries are pumping this money into their population, who are then buying Chinese TVs, and the Western populations aren't being employed. Do you think,
that's quite a feasible outcome. Again, that's another mistake. The extent to which we globalized production, that China did very well out of exploiting the willingness of American capitalists to rip off their workers by shutting their jobs down and moving factories to China and then exporting the goods back. So that is another thing which I was saying was a disastrous policy when I was first commenting that 40 years ago. It's happened. We've done it, and now this crisis comes along, and wow, isn't globalization great? But so there are my overall feeling here is that the economy should be the servant of the people, and what we've instead let it be is with this incredible inequality we've allowed, the majority of the people are being ripped off by the economy, and it's built into the structure of the economy because we've been doing it for 40 years.
But so coming back to the inflation question, do you think there is if this is, at what stage does inflation become an issue, I suppose? I
don't see it as an issue. The issue I fear is deflation. And that's, again, my original website was called debtdeflation.com.
Yep.
When the crisis hit, when the coronavirus crisis hit, I said that's the real danger, deflation. Because when you have corporations and individuals carrying the level of debt they're carrying right now, and then there's a plunge in demand, the response is, as it was back in the Great Depression, to cut prices, to try to drag customers in through your door rather than your competitor. Unfortunately, a competitor does exactly the same thing. Prices drop. You pay your debt off with the lower amount of revenue you've got coming in. That goes towards paying off the debt. That reduces the money in circulation. You actually have a fall in debt, which is exceeded by, which is less than the fall in GDP. So the debt ratios actually rise. That's the paradox Irving Fisher spoke about back then. And you have massive deflation getting locked in. That's what made the Great Depression great, in a sense, because for 2 years, the rate of inflation was minus 10% per annum. You just don't want to have that happen when you're carrying the level of debt we've got right now. And frankly, if you had some inflation, that would be a way of reducing the effective debt burden, so it wouldn't be a bad thing. The extent to which people fear inflation, 30 years after inflation was last a problem, closer to 40 years now, is a sign of our tendency to fight the last war.
Absolutely, but I guess what I definitely agree with you in terms of that deflation is the issue in terms of as people pull back and the whole debt. We're on board with the whole debt deflation. But I guess what I'm wondering is, if you took it, say, and you said you've got 20% unemployment, but you're still paying those people the same amount of money, and they're still spending money, is you sort of go, okay, well, is that enough to generate inflation? What if it was 50% of people were working and 50% aren't working, but you're still paying the 50% not working? And then you go 80% people not working. At some stage you go, okay, now there's a genuine, if you're going to keep paying people for not doing work, does it start becoming an issue at 20%, or do you think it's actually the unemployment rates are so much higher where that inflation would actually be an issue, that too many people chasing too few goods?
We're talking rationing. I mean, if you're talking about that scale of disruption, you're talking Second World War rationing, okay? Nobody complained about the rate of inflation during the Second World War. And it's partly because all you're doing is you weren't even drinking coffee. You would, what do they use? Forgotten the stuff they substituted for coffee.
Bovril? Bovril? Was
it? Sorry, you'd have to force me to drink that stuff. No, anyway, coffee substitutes existed, cigarettes were rationed, etc., and only basic goods were produced. That's exactly the situation we're in under coronavirus. You don't want people out there, making Dyson hair wand curlers. You just leave the factories running that provide absolutely essential goods, food, water, sewerage, internet these days, which would be, I think, we'd be going crazy with. We're going crazy because of it. We'd go even crazier without it. You need those things supplied, not anything, in the expensive luxury world. So the actual commodities you're talking about won't even be produced if the situation goes on to that degree.
Yeah. Okay. So in terms of, so we've spoken a little bit about the idea that the money's going straight to the people. If the governments decide to instead sort of put back more money into say infrastructure and corporate tax cuts and things like that, I guess your views on which of those are sort of effective and which of those aren't.
Sorry, I knocked over a bowl of fruit over here. I would rather see the cash flows just at the moment. And in terms of infrastructure spending, again, that's something which is compromised by the coronavirus. You don't want people working in areas where they're likely to transmit the disease to each other. So in some ways, we're on hold here. So the cash flow to people is the easiest thing to do, particularly the Australian economy, thank God, as I've realised from being in the UK, because everybody does a tax return. The government has an automatic method of getting money into your bank accounts. The UK doesn't have anything well organised like that. So it isn't possible to give cash through the fiscal authorities to people directly, like remember the $1,000 handout that Rudd and Swan gave during the financial crisis. The British actually decided they would take 6 months to organise that. So because Australia's in a situation where it can do it, just provide the cash flow. If you're going to do anything infrastructure, limit it to something which reduces our dependence upon coal and natural gas, which of course is the opposite of what Scotty from marketing is actually doing.
Actually, just while we're on that topic, I've got a question that's just popped in, Steve. It's a bit of length to it. There's a little bit of background. Arguably, a weak point of the debt-loaded status quo is the banks have a monopoly on operating deposit accounts at the RBA. Having regard to the abuses by our banks of their privileges in our monetary system, surely it's time to allow the general public and non-bank organisations the right to open and operate a non-interest paying deposit account at the RBA. Thoughts on that one? And there's a little bit more to
look,
it.
that is actually something which central banks have been looking at before the crisis hit, and what they call central bank digital currencies. So using, for the currency these days is almost entirely digital anyway. So they're sort of partly combining that with the idea of some sort of blockchain technology with a limited ledger, which the central bank and the Treasury can see, but not everybody else. And that would be the ideal way of giving everybody an account at the central bank. And some of the idea is that it's, as a way to replace cash. I'm not a fan of that because I don't trust people running money who don't understand money. But if we had central bank digital currencies and everybody having an account there, then that would be ideal. And in terms of particularly the behaviour of Australian banks, they've completely abrogated the responsibilities that come with the privilege of being able to create money. So I utterly agree. We should, enable people to have deposit accounts at an institution like the central bank. And if the private banks complain about it, well, say, well, you've done such a great job of managing the financial system, tough luck for you.
And I guess,
of course,
if it's a non-interest paying deposit account, then it provides the incentive for the for the retail banks to beat that, doesn't it? You sort of give them the competitive.
If they don't want to lose all the deposits, exactly.
Yeah. Yep. Okay. Very good.
Okay, well, talking along those lines, then. So, I think obviously European. I think we spoke last time about it. So European banks very much struggling to because there's such a flat yield curve, struggling to get the incentive for banks to get out and lend money. Are we without negative short-term interest rates? Are we stuck in the sort of a similar situation, around the world? And I guess, what are your thoughts on the relative arguments between negative interest rates and how to incentivize private banks and so that they don't go broke themselves?
Well, I've argued since about 2012 or 11 that we need a modern debt jubilee to get rid of the overhang of private debt, because what we've allowed happen, like you're looking at the American data, which I'm looking at right now, American private debt went from 38% of GDP in 1946 to 170% at the financial crisis. So you had a almost 4.5 times increase in the level of private debt, which should never have happened. We need to get it back to the stage where private debt is of the order of 50% of GDP, which is a sustainable level for most economies. And one way to do that is for the state to use its money creating capability, which is part of what MMT talks about, to give everybody on a per capita basis a cash injection. So you don't benefit those who speculated against those who didn't speculate. And with that money, those who have debt must pay their debt down. Of course, there's complicated mechanics in working out how to do that, given all the bloody covenants that exist on debt these days. But those who don't have debt get a cash injection, which I would, in most cases, require people to use to buy newly issued corporate shares that must be used to reduce corporate debt. And we can get back to a level of low household and low corporate debt, and have a rebalance the economy. Now that was something I wrote it up in 2012, I think, on my debt deflation manifesto. I haven't bothered working with it because I thought it was a pie in the sky policy. But when the coronavirus hit, I thought, absolutely, now this is what we need to do. If the government did that, used its money case and capability to create fiat money to replace credit money fundamentally, then we could come out of this crisis with a rebalanced financial sector and without massive bankruptcies. So I'd far rather do that. And I don't want banks to continue just lending from the level we're at. There's too much private debt. We have to get it back down before we try to encourage them to lend again. And when we do, we encourage them to lend for productive activities rather than Ponzi schemes.
So in terms of that, then, so I guess you're sort of, in a way, you're advocating that the banks are, under that scenario, the banks are going to need some sort of public bailout or
No, they wouldn't, because if you, again, this is why you've got to think in terms of assets, liabilities, and equity. Okay, if you gave everybody the capacity to pay their debts down by 2/3, which is what I'm talking about, from 150% of GDP to 50% of GDP, then when that was used, that money would be paid off loans, but there would be, as loans fell, reserves would rise. So banks would have at the same level of assets. Their liabilities would be the same, their equity would be the same, but their income would be downside lower because most of their assets would be reserves, which don't earn interest for them. So they would then be encouraged to lend by the fact, but they would not be driven into bankruptcy or into negative equity.
But Steve, does that then just create the same situation all over again? Like, would there need to be some?
If you let banks do what they bloody well want to do, of course it does. Yeah. So, like, I had the range of other policies I suggested in that manifesto. One was what I called the pill, which used to be much funnier back in my day. Property income limited leverage. And that would say that banks pretend to be lending on the basis of the income of the borrower, which is garbage. they're forever moving the goalpost. We know how much Australian banks have done to fraudulent records of people's income fundamentally, which they've now been encouraged to continue doing by our so-called regulators. I would instead say that there's a maximum amount of money which can be lent against a property based on the expected income earning capacity of that property, which we have statistical surveys that already work out imputed rents. So if you have a property which is going to earn rent on a year of $50,000, so you're paying $1,000 a week to rent a place, which is a fairly reasonable rent. The maximum anybody, including Kerry Packer, Jamie Packer, I forgot Kerry's disappeared, or Rupert Murdoch could borrow would be 10 times that, $500,000. And then with that rule in place, you wouldn't have people, you couldn't have people competing with each other by trying to get higher amounts of bank leverage. The leverage would be capped. And the only way you could beat somebody else at an auction was by saving more money. So a rule like that would mean it's no longer, you don't have this runaway growth in private and household debt, which of course has been what's caused the situation Australia is now in.
Okay, so there's assuming though that I think governments aren't going to take up your suggestion, which I think's
a good assumption.
A good assumption, yeah. What do you think?
No, it's not a good assumption. It's realistic. We can't have realistic assumptions in economics. Right. That destroys the whole, the whole modus operandi.
Mm-hmm. Yeah. So what's the most likely outcome then? So are we headed down the path where we say, no, let's go back. Let's assume it's all over, and we'll just try and we'll try and pump house prices up and hope for the best, or are we in a government? Is it going to be more of a government-sponsored, JobKeeper forever type thing?
I think we'll stumble in and out of that. Yeah, I mean the most important thing in Australia is to make sure house prices continue rising, so everything will be sacrificed to get higher house prices. And then JobSeeker will be put in and pulled off, and they'll put conditions on JobSeeker, like you've got to apply for 40 non-existent jobs a week to hang on to JobSeeker, so people have nervous breakdowns lining up for Centrelink, which will also underfund. So yes, I expect business as usual in Australia, unfortunately.
Just on that as well, Steve, another question that's come in. If we're being honest, the government has done everything it can do to prop up housing prices. You were saying prices were going to crash a decade ago, but it never happened, and now we're seeing eye-watering prices in Australia. What can you foresee as possible things the government and banks will do from here to keep property prices up? So what levers do you think are left?
Another first-time owners grant for sure. They're already doing that, aren't they?
Mm-hmm.
Yep.
Okay.
And now you can renovate your house as well with a grant.
First-time renovators grant, yeah. So this is all the money creation capability of the government, which it does have in Australia, is going into propping up house prices, rather than developing the economy or giving people a basic income. So in that sense, they claim to be anti-MMT, but they're practicing it. But all the pressure is going into the housing bubble, rather than going into the real economy. And we end up therefore with a emaciated, almost non-existent manufacturing sector. And suddenly we can't import from countries overseas anymore because of the virus. What do? Well, we do without.
So in terms of house prices then, so what's, I mean, I guess we've taken the view that, as you said, they're going to do whatever they can to prop it up, but we're not quite sure if they can or not. And we sort of feel as if they don't manage to prop them up, there's actually it's a non-linear relationship. You'll go off the cliff and you'll sort of get the snowball effect of people selling and unemployment and banks foreclosing and having to pull these things. I guess what are your thoughts on that view, and where are you? What's the range of possibilities and the probabilities that you're seeing?
Oh, I think that's. I mean, they'll continue obviously propping up house prices no matter what, because for a start, the banks would fold if house prices fall substantially, and the politicians listen to the banks rather than listen to the people. So, and the people themselves want, not everybody, but those with property, the speculators want prices to keep on rising, and can see nothing wrong with the increase in the house price index. That is highly likely that they'll continue propping it up. I think, again, this is one thing the government has. This is one thing about MMT. There is no limit to the state's capacity to create money. So if you have a state which is dedicated to creating money to maintain a housing bubble, then they'll do it. And this is the trouble. You can continue doing this even while the physical economy falls apart around you.
I guess switching back to a global view, I guess you'd typically think that the US would sit more on the, just let things fail and then we'll clean up the mess later, whereas Europe would sit more on the let's let the government step in and help as much as possible. Is that seeing what you're seeing as well? And what do you, in terms of the different candidates that from the election, do you think you might see more government support in the US than you might have otherwise seen?
I don't know, mate. We're talking about Donald Trump. So, I mean, the way things are going, I've got a feeling he's going to win. Not win the next, win in the same sense that somebody who fixes a horse race wins the horse race. But yeah, he's doing everything he can to steal the election, and I think he probably will succeed. And I'm not about to try to predict the behaviour of a malignant narcissist over the future.
I do.
So, but to me, yeah.
I have said in the past, I sort of feel as if someone could explain MMT properly to Donald Trump, though, he'd actually love the idea of free money. It's
Yeah, I mean, if you realise, he's probably got some knowledge of accounting because he's been involved in so many bankruptcies. I'm sure he's learned a fair bit. But this is the point. It's actually probably worth talking the technicals of MMT here, because this is something which, my work, as you probably know, has been focused upon private debt, credit, and what banks do in the money economy. And I've really treated the government as a sideline in the sense that I haven't tried to build models of government behaviour. But recently I've done that using my Minsky software. And this was after reading Stephanie Kelton's book, The Deficit Myth. And most things in the deficit myth weren't any surprise to me at all. But there's one claim that I have always hedged on my own because I haven't worked it out myself. And that is that Stephanie was claiming that the deficit itself creates the money that's necessary to finance itself. And when everybody asked me, does a government deficit create money? My gut interpretation was saying, to the extent the central bank buys the Treasury bonds. When you look at the accounting, that's wrong. And so I'm happy to say I got something wrong there, and my Minsky software has established it for me. So what you need to look at is when people like Kukelas and others panic about the government, because there's so much deficit, it's got to pay the debt back later, and it's all a panic. Can the government manage to sell the bonds? Will bond vigilantes demand too high a price for government bonds? Will they not be able to sell enough of the bonds? That's all accounting nonsense. But it takes a comprehensive view of accounting to understand that, and that's what my Minsky software let me develop. So the insight that I got out of building a model of MMT was that when you look at it and say what is money, first of all, money is fundamentally what's in our bank accounts plus cash. So leaving cash out of the equation, anything that creates money has to create more money in bank accounts in total, which means you can't create money by shuffling money between two people's deposit accounts. And you can't create money by shuffling things between one asset and another asset on the bank's books. The stuff that creates money is something that happens both on the asset side of the bank and the liability side. Therefore, assets rise and liabilities rise. Now, the things that do that are lending money. If banks lend, they increase their loans and they increase their liabilities because if they loan you $1 million means they put $1 million in your deposit account. That increases their asset by $1 million as well. Government spending does the same thing. If the government spends, it puts money in your private bank accounts, and that is balanced by an increase in bank reserves precisely the same amount. So those two activities create money. Now, the gap between tax and spending, the gap between lending and repayment creates money. Now, once that's done, in the case of government spending exceeding taxation, that's created excess reserves that banks now have that earn them no interest. So if the Treasury comes along and says, we're going to sell your Treasury bonds equivalent to the deficit, what they're saying to the banks is, here's a swap from one asset to another. One you don't earn interest, the other one you do. Would you like to buy some bonds? The answer is bloody hell yes, which is why they buy the bonds. So there's no problem in selling government bonds to finance any scale of deficit.
Yeah, and I've always said as well, that with the bond vigilantes, well, if you can print your own currency, you need to worry if you've got bond vigilantes in your own central bank.
You can't. You can have bond vigilantes if you're borrowing in a different currency. So if the Australian government was issuing American dollar bonds, we'd be in big trouble. But because we're issuing Australian dollar bonds, that deficit directly creates excess reserves that banks want to put somewhere else to get on the financial sector in general, not just banks, want to put somewhere else to get a positive return.
Just on that, Steve, another question that's dropped in. So you seem to have an alternative view. Sorry, questions are flying in here. Here we go. You seem to have an alternative view to key MMTers on exports and imports rather than just being a straight forex swap. Just a question: can we go over your views and have you refined them recently?
Yeah. Well, if you look at my work comes of what Wynne Godley called sectoral balances. So I've actually, with Minsky, the software, I've developed the capacity to build a comprehensive model of sectoral balances for a domestic economy. And Wynne's point was that the sum, because money has to go from somewhere and end up somewhere, even though the aggregate of money can rise and fall, spending is identical to expenditure. So if there's one sector's running a deficit, the other sectors of the economy must be running an equivalent surplus. Overall, they balance. So if you've got a government running a surplus, the private sector must be in deficit. If you're looking just at the domestic level, when you have a third sector, include the overseas trade, then if the government's running a surplus, the trade account can be in surplus as well. We define that badly. We should actually call it a deficit, but we give an inverted definition.
Yep.
A government surplus can be maintained by a trade surplus. So it's actually beneficial, in my opinion, to an economy to run a trade surplus, to export more than it imports, because that ends up creating cash domestically. And the MMT should reach those conclusions, but this is where there's quirks in MMT, because Warren Mosler was the originator of MMT, and Warren, as well as saying that the government doesn't tax to spend, it spends the taxes, which is absolutely correct. He also says exports are a cost and imports are a benefit, which is nonsense.
Right.
Okay. And so I'm sorry, a lot of the MMT people pussyfoot around that stuff. If you read Stephanie's book, she hedges that whole area. Doesn't make any particularly strong statements one way or the other, and talks about monetary sovereignty and the need to build up your industrial base and so on. But Warren's argument, and it's supported by Bill Mitchell as well, is simply that exports are a cost and imports are a benefit. So it's beneficial for a country to run a trade deficit because you're sending pieces of paper overseas and getting physical goods back. I think that's silly. It contradicts the fundamental sectoral balances side of MMT itself. It has to accept a whole range of mainstream economic ideas like comparative advantage and opportunity cost, which just have, in my opinion, have no place in a sensible analysis of a market economy. They're mythical textbook ideas. For a start, the idea that a country is sending if America exports a Tesla to Australia, then that's the cost because it could have used that Tesla domestically. That Tesla is increasing the level of capacity utilization of Tesla's factories, enabling it to lower costs overall and providing investment funds. So I think that side of MMT I completely reject. I was keeping quiet about it before coronavirus because I take my hat off to MMT advocates with their success in getting a non-orthodox theory, getting the airplay that MMT has done, and I didn't want to derail them. But when coronavirus hit, it makes a mockery of the whole idea of send money overseas and gets goods back. You try sending money to China right now to get masks. Can you make masks? No, you can't. Oh dear. We should have not sent away our mask-making capacity in the first place.
Yep, and I guess actually just a follow-on question as well, it probably ties in quite nicely to the theme. How could the Australian government strategically position the country for competitive advantage if someone who knew what they were doing were driving the budget?
Well, we'd be trying to build an industrial base. We'd be trying to build self-sufficiency to a large degree. Again, the whole neoclassical focus upon comparative advantage is another piece of nonsense. The real way you build over time is not by specialisation, it's by innovation and development. And if you had an economy that's trying to innovate and develop within the constraints of its physical size, then you would have a manufacturing sector here worth talking about. Instead, because of the comparative advantage argument, Australia, as David Llewellyn-Smith has in his name, is all about houses and holes, sending minerals overseas. And building expensive houses as a result of it, or building up the price of houses. You don't have a manufacturing sector. We have a lower level of industrial complexity than most third world countries. We can't produce the industrial goods we need. And now, because of coronavirus, and I'm pretty certain as well because of the impact of global warming over time as well on international trade, we won't be able to make those goods. How do we do it? Well, God, we've got to train up the engineers. We've got to build the machine tools capability. We have really handicapped ourselves for a complicated future. And I would be saying we've got to build up that industrial capability, build up the engineering, and reward innovation rather than speculation on the Australian economy.
Which sounds like we need a lower currency.
Yeah, well, we're going to get it anyway, I think. But like at the moment, the trade balance is pretty positive right now, isn't it?
Yeah, well, I guess it's an interesting question with some of the mining companies when the money comes in and then cycles back out again relatively quickly. And
yeah, we don't know. We're a country of workers, not capitalists, because we've exported. Even Vegemite's owned by an overseas company. So we because we were on those trade deficits for that length of time, we've ended up selling the ownership of the Australian economy, and that is a major issue for the future. We didn't, of course, when we developed car companies, we had Holden when we sold it 100% to General Motors. So we haven't had an idea of building up a domestic industrial capitalist class, which is what we should have done.
Yes. In terms of sort of moving on to some of the monetary responses from central banks, I guess we've had the RBA sort of suggest that a lot of what they would call extreme stuff around negative interest rates and more money printing and Operation Twist type factors, they've seemed to be saying that they don't think they need to do those, and it's sort of a little bit over to the government now to sort things out. Do you think they're going to have to step back in and do more before the end of this?
You mean the central bank?
Yeah. And what are the how long do you think before? Sorry, I guess what are the key tools you think, key unconventional tools that they're going to start using first?
Well, fundamentally, the central bank shouldn't be doing the stuff the Treasury should. And that's the problem. The Treasury is run by conventional economists, so you're not going to get any ideas like this being accepted there. But it's the Treasury that can put money into people's bank accounts, not the central bank. This again is something which comes out of the Minsky modelling I've done. When you look at the impact of government spending, or if you're going to get money into the private bank accounts, you have to be putting money into the liability side and the asset side of the private banking sector. The central banks could possibly do that, but that's usurping a function for the Treasury as it's currently allowed. I certainly don't want to see negative interest rates because that whole idea is based on the concept that banks lend out reserves. There are excess reserves. If we put a negative interest rate on reserves, that'll encourage them to lend. In fact, they can't lend reserves. The only way you can physically lend reserves is if you make all loans in cash. And then you have to stop people depositing that cash back in the banking sector. Otherwise, it defeats the purpose. So banks, the whole idea that banks lend money out of their reserves is the textbook thing that the Bank of England and the Bundesbank have both said is wrong. Banks do not lend reserves. So negative rates on reserves is based on a textbook fallacy. And if you do it, it gives banks a non-performing asset, a negative asset, which encourages them to generate more of a positive asset, which means more speculative behaviour by banks more Ponzi scheme lending. It's the last thing we need. So I don't want the Reserve Bank or the central banks to bring in negative rates. What I want them instead to do is to be conduits to reduce the level of private debt.
And so sorry, I'm still struggling to see. So if the Treasury's more conservative and so aren't actually doing the things they should be doing, is there anything that the Australian Central Bank, what should the Australian Central Bank be doing to try and I guess spur the Treasury? So is that a matter of getting long-term rates down so that they can borrow at whatever 0% rather than 0.8%?
Doesn't matter. I mean, this is the thing. The government's borrowing rate is not a problem to the government, because if you look at if you're issuing running a deficit, then you're running up reserves, which no interest is paid on, no positive interest is paid on reserves. If you issue bonds, you pay positive interest on that. That interest is paid by the Treasury, and they borrow the money from the central bank to finance it. So and because they own the central bank, so there's no debt for the private, no servicing problem for the government in doing that. So you can pay any rate you like on those bonds. It's more the fact we've got this high level of private debt. That's what we need to focus on, and that again, neither certainly the Reserve Bank of Australia, with the exception of Fisher and Kent, the only two people in the bank who understand private money. With the exception of that, the central bank is like talking to a 1960s economics textbook, and not about to do anything interesting.
So your expectation at the moment is we probably won't do stuff on fiscal. We probably won't do the right stuff on fiscal or enough of it.
We'll do some, but not quite enough. Yeah.
And that the central bank probably won't do anything much until they're forced to by crisis.
Yeah, and one thing I'd like to see them do is the suggestion that the questioner made earlier, and that is to introduce central bank digital currencies and give everybody an account at the central bank. That would be, if they do that alone, I'd be happy. That'd be a major innovation, which will be seriously useful in the future.
Are they? It seems to me though, we seem to be a fair bit behind other central banks. And so
miles behind the Bank of England. Absolutely miles behind the Bank of England. I mean, the Bank of England, I was dealing with the research group staff of the Bank of England back in the early 2010s, and they already had people there who understood sectoral balances, who were building stock flow consistent models of the economy, as well as those doing neoclassical dynamic stochastic general equilibrium models. When the crisis hit, they realised that and this is quoting one of the builders of DSG models, I won't give his surname, but his first name is Stephen, told me quite frankly, and this was said very regularly, our models were wrong. Okay, models didn't, and that was quite honest, and I was impressed by that. So the Bank of England recognised that its models were wrong, recognised that those who were doing non-standard models were more correct, and then they've boosted their non-orthodox research. In general, they brought in physicists, mathematical biologists, a whole range of other skills into the bank as well. So I have a lot of time for the Bank of England. The Bundesbank blew my socks off by coming out and also saying that the approach I take to money, the endogenous money approach, is correct and the textbooks are wrong in 2017. The Bank of Norway, similarly. Even the Bank of Sweden, to some extent, is ahead of the mark in terms of developing central bank digital currencies. So yeah, Australia's a backwater.
Excellent. I don't know, Tim, if we've got any more questions.
Look, there was a couple here. There was just one just touching on going back to, I'll just read out the question here. So does Steve agree that when the government sells bonds, it is essentially converting what would be non-interest accruing central bank deposits into private wealth asset that accrue interest? And how is that in the public interest?
Well, it's actually intriguingly, that's an intriguing question, because I would agree. I prefer, like initially, I would have preferred the government just to issue and run a deficit, and the increase in reserves is matched by a negative balance in the treasury account at the central bank. That's what would be the consequence of running a deficit and not issuing bonds to cover it. When you look at them issuing bonds, all they're doing is the bond revenue transfers money from the reserve account of the private banks at the central bank to the treasury account, and enables the treasury bank account to remain non-negative. That's what's going on with the bond sales. But what also happens is you pay interest on the bonds. And this is, I haven't mentioned this yet, and this is something, again, which came out of my Minsky modeling. The fundamental operation that increases the money supply is something which increases the asset side and the liabilities and equity side of the banking sector. And if you're paying interest on bonds, you're actually, that's a increase in reserves, which is an asset for the bank. There's no liability attached. That interest goes to the equity of the banks. And that actually creates additional money, which then circulates in the economy. So when I model the economy with the government just running a deficit and not issuing bonds to finance it, I get a lower level of economic activity than if I have them paying interest as well, because the interest ends up creating more money on top of that. Not an effect I expected. Okay, but that could be countered by saying we'll run a bigger deficit then, in terms of creating the amount of money. So in a sense, you get more bang for your buck in creating money in the private sector by selling bonds, which then let you, as well as converting reserves into non-income earning reserves into income earning treasuries, it also pays an interest flow which doesn't exist without the treasury bond sales. So it's not a straightforward answer, but it's not a straightforward problem. So I would prefer, because I think if you think about what happens as well, if you pay interest income to the financial sector from bonds, then that means that there's an income flow going to them, and they don't need to worry about going out and making lots and lots of money by lending to the private sector for speculation. And if you think about what banking used to be regarded as, remember the old, was it 363 formula?
Yep.
Okay. Lend at 3, borrow at 3, lend at 6, and be on the golf course by 3 o'clock. I would prefer a financial sector that does that to the twerps we've got in Macquarie Bank and so on, who are out there pumping out debt and assets and speculation left, right, and bloody centre. So if the government's providing an income stream from treasuries to them, that reduces the pressure on the bank's mentality to go out there and pump debt into the private sector. And that may be a better thing than the not doing it. So in balance, I'm in favour of selling treasuries, offering interest on that, and reducing the encouragement banks face to pump up debt in the private sector.
Okay, no, great answer. And it sounds like a terrific question as well. Thanks to PFH007. He's popped in a couple of good ones today. Just a couple more. So we've got here, does quantitative easing lower the multiplier effect despite M2 rising? So is that M2 broad money supply? If none of the QE money gets lent out by banks to people, would there actually be any chance of monetary inflation?
Yeah, good point. Now, when you look at what QE does, quantitative easing is fundamentally the central bank saying it's going to be in the open market operations it does with the financial sector all the time, which we used to be used just to maintain the target interest rate on short-term government bonds. With QE, they say we're going to be on the buy side. Over the year, we're going to buy X amount of bonds off you, more than we sell to you. Now, in the American case, that X was $80 billion a month, or basically $1 trillion a year, a lot of cash. And what that meant was they were buying $1 trillion worth of bonds off the financial sector. That means the income earning assets of the financial sector, I mean, a lot of them were junk bonds, but they went down. The non-income earning reserves went up. So what do you do with non-income earning reserves? You buy, as a financial sector, you're required to buy financial assets with it. So you buy shares.
All right. Yep.
Okay, which pumps up share prices. Now, none of that's turning up on Main Street until people have sell their shares, and if there's rising share prices because of the financial sector's buying shares, then people in the non-financial sector who sell shares have additional money which they sell and they then spend. You pay ludicrous salaries to people in the financial sector, including you guys. Sorry. And you guys go and spend, you get bonuses, et cetera, et cetera. So you get a leakage of that QE into the real economy. And, just being rule of thumb sort of thing, you might get $1.10 coming back. So you pump $1 trillion into the financial sector, you might get 100 billion on Main Street. So QE is a very ineffective, low multiplier way of getting money into circulation. And overall, yes, when people are carrying still those massive levels of private debt, they're likely to spend less rapidly, which reduces the multiplier.
Okay. Yeah, look, thanks for that. I've got another one here. How do you think the government should change incentives in order to achieve beautiful deleveraging? From Martin Tran. Have you got any pointers?
The only way to achieve beautiful deleveraging is to make up for the negative impact on aggregate demand of falling credit. And this is, again, it's something which I'm trying to incorporate in MMT now, because they haven't paid sufficient attention to the private sector, like I myself didn't pay sufficient attention to the government. So when you look at the role of credit actually increases aggregate demand, because we live in a world where banks create money. The money they create comes with a debt. Nobody goes into the debt for the sheer pleasure of being in debt. You borrow to spend. And the aggregate, that change in debt, which is credit, becomes part of aggregate demand. If you want to go in the opposite direction, you're paying debt down, then credit is negative and you reduce aggregate demand. So the only way you can have a beautiful deleveraging is by the government more than compensating for the deleveraging of the private sector. Now, the last time that happened on any grand scale was the Second World War. And if you look back in the level of the government deficit in 1942 in America was 30% of GDP. Completely financeable because of the whole MMT argument applies then as now. The deficit itself created the money that financed it. The bonds were sold because they were an asset swap for the financial sector. But that huge amount of government money creation more than compensated for credit demand being negative. And therefore you had a booming economy during and mostly immediately after the war and then after that. That's a beautiful deleveraging.
Okay. Oh, look, thanks for that. I might just pivot back to, I guess, the topic of the day in MMT, working some sort of solution to the coronavirus economy. So there was just a thought here, and you've probably been following Bill Mitchell, who's a proponent of MMT in Australia, talking about an opportunity to create a buffer stock of jobs in the public sector, harking back to the glory days of the 50s. And we've got one here, 1952 in New Zealand, there was 2 people receiving unemployment benefits and 50 registered and unemployed. Now, keeping in mind there was probably only a couple of thousand people in the country at the time.
You mean 2, like
as in
1 and 2,
1 and 2,
not 2%.
Yeah,
2
that's
people.
right. 2 people.
2 people.
2 people receiving the unemployment
My
benefit.
God.
And 50 registered unemployed. Keeping in mind, it's probably not a huge amount of people in the country at the time, so I don't know how that looks as a percentage. But thoughts on, I guess, going forward from there is a government jobs boom, and I know we've spoken a little bit about infrastructure, but is a blossoming public sector an opportunity to keep this unemployment rate down, and obviously using MMT as a method of payment potentially.
Yeah, I mean, it's certainly possible to finance, a job guarantee, and that's been Bill Mitchell's major campaign throughout his academic career. And in that sense, the financing side is easy; it can be done. And as MMT people argue in general, it's a pretty lousy way to control the rate of inflation to push people into involuntary unemployment, which is what happens. It's not that people volunteer to be unemployed. The jobs aren't there, and the jobs aren't there because of insufficient aggregate demand, and that can often be because of the private sector's own credit machinations that we go into a downturn. So saying there should be a job for everybody is a sensible way of meaning that there's not a destructive personal impact on people of public policy. So in that sense, I support the job guarantee. What I find strange is a lot of opposition to universal basic income as well. I know UBI has been exploited and treated very badly in some countries, but there are people pushing a UBI as a way of saying here's a base level of income which everybody gets, which is sufficient to live a sustainable life, if not an exciting one. You get more for a job guarantee, you get more for a normal job, and you get more again if you become a successful entrepreneur. That's the sort of scaling I would like to see. And certainly at the moment, we do have an enormous need to build the infrastructure of a sustainable ecological economy, which we do not have. We've gone well past it, in fact. So there's certainly work to be done, though I doubt I think there's so much that's necessary in terms of making our economy fit within ecological boundaries that ultimately we won't want people to work. We want, ultimately, we will have to separate the need to work for a living from the need to work for sheer interest.
Yep.
And if we survive what we're going through ecologically, and that's a big if, then on the other side of it, at some point, we won't have a lot of production on planet. And in that situation, you don't have the need for, I'm talking 200 years in the future, if we get that far, you won't have employment being a basis of income distribution. And we have to get ready for that.
Okay, very good. Thanks for that. And just finally, and obviously mindful of your time, and you have shared plenty of it with us today, Steve, some views on the present positioning of the stock markets around the world. And I've got a question there talking about gold and silver as well, but perhaps we'll tackle the stock market at present. If you've got anything to add.
Oh, no, that is, I mean, a lot of conspiracy theorists and critics of the Fed say this is a Fed-induced bubble, and they're dead right on that front. I mean, the Fed, if you look at particularly Bernanke's writings around 2010, he actually talked about the wealth effect and said if we get people feeling richer because we've driven up the stock market, they'll spend more and that'll boost the economy. That was a stupid way to rescue us from the financial crisis, but nonetheless stupid but effective if you have an unlimited capacity to do it. And that's given us these massively overvalued stock markets which bear no relation to the cash flows of the corporations. So we've very much distorted it. It has been the Federal Reserve that's caused it. And in that sense, I'm on the side of the conspiracy theorists there, but not because they know what they're doing, but because they haven't got a bloody clue. And there are other means which are much more effective, which modern monetary theory talks about, that they're not using.
Okay, very good. And just pivoting across to gold and silver, and I guess thoughts on that. And is there sort of the potential for a new currency reset? Is that relevant at the moment?
No. Gold. I mean, this is what I recommend reading work by people like David Graeber and Debt the First 5,000 Years, and I think Felix. I think of Felix's last name, but a book called The Money the Unauthorised Biography. They're looking at history. Gold and silver have only become money during periods of extreme social breakdown. Okay, and if you look at when gold and silver were used, it was normally during things like the 100 Years' War or the 30 Years' War in Europe, when you didn't trust the king's money because the king might lose the next battle. So both kings had to pay money in gold, and that was where gold became the currency. But once the battles were over, and there was a sustained political order, the king's fiat ran the realm, and money was created by fiat. Of course, in the UK, tally sticks were used, which were pieces of wood. Okay, that's where we talk about the tally and the stock and the butt, etc. These are all reflections of the days we used to use tally sticks as money. So even if gold were used as money, it's a social convention to accept it, because whoever gives you gold, you accept the gold because you can use the gold to buy somebody else. It always comes back to an issue of trust.
Right.
And I see gold and silver as speculative commodities that do well during a financial crisis, but I never see them as replacing actual money. And the whole idea that we could do that in a modern economy, I think, is ludicrous, given the physical amounts of gold and silver that exist. And if people say we're going to have gold and silver certificates, and when we're back in the same old, how do you trust issue? You don't get away from the issue of trust in money. So I can see currency regimes internationally changing and some currencies failing because of trade deficits. And then, wealth being put offshore and so on, Argentina being a classic example of that. But I don't see gold or silver taking over, but they can do damn well when there's financial volatility.
Yeah, when there's no trust in anything else, I guess that becomes the reserve. Very good. Well, look, thanks again for your time today, Steve. Look, fantastic run through, I think, both of obviously modern monetary theory and its correlation and its use potentially in what's happening in the economies around the world. Would you like to share with our audience today how they can follow some of your work and get in touch with you?
Sure. The main way is through my Patreon page, which is www.patreon.com/ProfSteveKeen. I'm happy to have support there. I've got about 1,500 supporters there who are paying me roughly what I got as a professor to do my research. I'd like to get more, partly so that I can hire somebody to do the bureaucratic stuff, which I'm hopeless at.
Yep.
But anyway, at the same time, when I started the website, I asked my patrons, do you want me to restrict posts for you or make them public? I said, please make them public, because we want non-orthodox economics to take over from the orthodoxy, and we want your ideas and the ideas of other rebels publicised. So most of my posts on patreon.com are freely accessible. So you don't have to support me to go there. If you do, the minimum support level Patreon allows is a US dollar a month, actually an Australian dollar a month. They've made it international now.
Have they?
Any currency. Yeah, it can be you support in your local currency, which is much, much better.
Yep.
So I've got about 500 subscribers paying me $1 a month. I've got a few paying me $100 a month, and one very generous soul paying me $1,000 a month.
Wow.
So that's, you choose your amount of support. It can be nothing. If you just want to read the ideas, $1 a month provides me with some cash flow. And I must say, being on Patreon, I'm getting far more research done than I ever got done when I was working at a university. So it's been an absolutely fabulous experience for me.
Wonderful. Yeah, no, I've always enjoyed your chats with Phil Dobby as well on your weekly podcast. Was it? Yeah, thereabouts. So keep it up. And on that note, look, thanks again for your time. Apologies to everyone who was tuning in for the delays a little bit earlier. We had just getting some sound things organised, but I'm glad we've come through clearly, and it's been a terrific show. So on that note, look, thanks once again for your time, Steve. Thanks to everyone who's put in a massive amount of questions. It's been a real challenge just trying to get through them all and work them into the conversation today. And I apologise if we've missed too many, but we can certainly look forward to getting you on again soon, Steve.
I'd love to. It was good fun talking to you guys.
Lovely. All right, all the best. Catch you soon.
Okay, bye-bye.
Bye. Just on that note as well, of course, thanks again, as I mentioned, for tuning in. We hope you've enjoyed today's show, and if you'd like to see more of our content, head over to nucleuswealth.com/content. To stay up to date on news from us, follow us on social media. We always appreciate guest and topic suggestions, so if you've got one, drop them in the comments of today's YouTube video. And finally, if you know anybody, of course, who'd get something out of today's episode, let them know about it, share with a friend, and help our podcast grow. So on that note, bit of a long show, a bit of a late start, so thanks for your patience there, and we'll look forward to catching you at the next one. Cheers.